Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Hello everyone, I am Dr. Chetna Marvadi, Associate Professor, School of Commerce, Gujarat University. Today, we are going to study Part 2 of Unit Costing. In Part 1 of Unit Costing, we have studied about number 1, meaning of Unit Costing, number 2, applicability of Unit Costing, number 3, how to measure Unit Costing, number 4, meaning of cost sheet, number 5, elements of components of cost sheet, number 6, types of cost sheet, that is historical and estimated, number 7, relationship of production with variable cost and fixed cost, number 8, format of cost sheet, and number 9, simple practical problems on preparation of cost sheet. We have studied about different methods of absorption of factory overhead, administration overhead and selling and distribution overhead, and now in Part 2 of Unit Costing, we will study about how to apply or use absorption method of different overhead in cost determination of a product or a service. Students, you are required to refresh chapter of overhead for better understanding about absorption of overhead and specifically part number 4 and part number 5 of overheads for comfortable understanding of this module. Now, we will discuss about estimation or base for charging direct wages and direct expenses as well as of recovery methods of different overheads. Number 1, direct labor or direct wages can be based on materials consumption. It means direct labor cost and direct expenses can be certain percentage of direct material. It is possible in material intensive product. Number 2, factory overhead can be based on prime cost or based on machine hour rate or based on labor hour rate, etc. Number 3, administration overhead can be based on factory cost or can be based on per unit cost of units produced. Number 4, selling and distribution overhead can be based on administration cost or can be based on per unit cost of units sold. Now, let us see the illustration explaining different situations for determination of total cost and per unit cost. Let us understand with the help of illustration. Illustration 1. You have provided cost related data of Rachna Company Limited for its product Lion. Prepare statement presenting total estimated cost and per unit cost. Direct material rupees 45,000, direct labor 33 and 1/3% of direct material cost, direct expenses 20% of direct material and direct labor cost, factory overhead 1/9 of prime cost, administration overhead 25% of factory cost, selling and distribution overhead 10% of administrative cost of goods sold, units produced 100, units remain unsold 10% of units produced and profit 1/6 of sales. Let us prepare solution. For the purpose of solution, note that number 1, bifurcation of overheads in terms of fixed and variable is not given. Thus, these overheads will be assumed fixed. Number 2, all direct costs, that is direct materials, direct labor and direct expenses are always variable, so their bifurcation is not needed. Number 3, no information is given for opening stock, hence will be assumed 0. And fourth, production account will be prepared. Let us prepare production account. On the debit side, we will write opening stock and production. Opening stock as nil as it is not given and production as 100 units as it is given in the example. Closing stock given as 10 units we will write on credit side and therefore, the balancing figure of 90 units will become our sales unit. So, from production account we have calculated sales unit of 90. Now, let us prepare statement presenting total and per unit cost of product lion. For that we will prepare 4 column: particulars, units, total cost rupees and per unit cost rupees. First we will write direct material cost as given in example 45,000 per unit cost comes to rupees 450. Direct labor cost, it is 33 and 1/3% of 45,000, which is material cost, amount comes to rupees 15,000 and per unit is 150. In that we will add direct expenses, that is 20% of material and labor cost. Material cost given is 45,000 and labor cost given is 15,000, making total of 60,000. Therefore, 20% of 60,000 is rupees 12,000 our direct expenses, and per unit direct expense is rupees 120. Direct material, direct labor and direct expense total comes to 72,000, which is our prime cost. In prime cost, add factory overhead, it is 1/9 of 72,000, which is our prime cost, amount is 8,000, per unit cost is rupees 80. That will give us factory cost of rupees 80,000. In factory cost, add administration expenses, it is 25% of 80,000, amount is 20,000 and per unit cost is 200. It will give us administration cost of goods produced as rupees 1 lakh and per unit cost is 1000. In administration cost of goods produced, add opening stock of finished goods, which is given as nil, and deduct closing stock of finished goods, which is 10% of rupees 1 lakh, that is 10,000, which will give us administration cost of goods sold as 90,000 and per unit cost comes to 1000. In administration cost of goods sold, add selling and distribution expenses, which is 10% of 90,000 cost of goods sold, amount comes to rupees 9,000 and per unit cost comes to rupees 100. It will give us total cost of sales, which is 99,000 and per unit cost of sales is 1100. In total cost of sales, add or less profit. Profit given is 1/6 of sales, that is sales given is 1,18,800 and 1/5 of cost, that is rupees 99,000. We do not know the figure of sales, therefore, we will apply as 1/5 of cost 99,000 and the profit comes to rupees 19,800 and per unit profit is 220. Therefore, giving us sales value of rupees 1,18,800 and per unit sale value is rupees 1,320. Let us have a look at explanation for this solution. Number 1, direct labor and direct expenses are based on material cost. Number 2, factory overhead is based on prime cost. Number 3, administration overhead is based on factory cost. Number 4, selling and distribution overhead is based on cost of goods sold, not on goods produced. Number 5, profit is 1/6 of sales, but we do not have sales, but we also have the cost of sales will be assumed as rupees 100. Sales 100 less 1/6 profit, that is 16.66%, which is equal to 83.33, it is our cost. So, equation will be rupees 83.333 is the cost, then 100 is sales. If our cost is rupees 99,000, what will be the sales? Then the equation comes to 99,000 divided by 83.333 into 100, sales will be rupees 1,18,800. So, confirmation is that profit 19,800, which is 1/5 of cost price of rupees 99,000. Now, in next illustration, we will study about valuation of opening and closing finished stock, where certain expenses are based on percentage of other expenses. Let us understand accounting treatment of this issue. Illustration 2. X Limited has provided cost data to prepare a statement showing the total cost and profit per unit. Direct material consumed rupees 4 lakhs, direct labor 40% of direct material cost, direct expenses 50% of direct labor cost, factory overhead 25% of prime cost, office and administration expenses have been absorbed at rupees 150 per 10 units produced, selling and distribution expenses have been applied at rupees 500 per 100 units sold, opening finished stock 800 units at rupees 85.50 per unit, closing finished stock 400 units, finished goods sold 16,400 units and profit is 1/6 of sales. Let's prepare solution. For that, note that number 1, in this question we are provided opening stock, closing stock and units sold. So, we have to ascertain units produced. It will be ascertained by preparing production account. Let's prepare production account. Opening stock given in the example is 800 units, sales given is 16,400 and closing stock given is 400. So, opening stock we will write on debit side, sales and closing stock we will write on credit side, making total of credit side as 16,800 and the balancing figures comes on debit side as 16,000, which is our production. Number 2, as explained earlier, up to administration cost of goods produced will be calculated on units produced. Thus, units produced are required and hence it comes to 16,000 units. Further, all selling expenses are calculated on units sold, which are 16,400. Let's prepare statement presenting total and per unit cost of product of X Limited. We will prepare a statement under 4 column: particulars, units, total rupees and per unit rupees. Direct material cost given is rupees 4 lakh. Add direct labor cost 40% of rupees 4 lakh, which is 1,60,000. Add direct expenses 50% of labor cost 1,60,000, which is rupees 80,000, giving us prime cost of rupees 6,40,000 and per unit prime cost is rupees 40. In prime cost, add factory overhead, which is 25% of prime cost, amount is 1,60,000 and per unit cost is 10, which will give us factory works cost rupees 8 lakh, per unit cost is rupees 50. In factory cost, add administration expenses, which is rupees 150 per 10 units produced, or alternatively it is rupees 15 per unit, that is rupees 150 divided by 10 units and amount comes to rupees 2,40,000, per unit cost is 15. Works cost plus administration expenses gives us administration cost of goods produced, amount is rupees 10,40,000 and per unit cost is 65. In administration cost of goods produced, add opening stock of finished goods, which is 800 units and per unit cost is 85.50, giving us the value of 68,400. Less closing stock of finished goods, units are 400 and its valuation is 10,40,000, divide by 16,000, multiply with 400, or alternatively 400 units multiply with 65, amounts comes to rupees 26,000 and the total gives us administration cost of goods sold rupees 10,82,400 and the per unit cost is rupees 66. In that, add selling and distribution expense rupees 500 per 100 units sold, or it is rupees 5 per unit, amount is 82,000 and per unit cost is 5. That will give us total cost of sales 11,64,400 and per unit cost of sales is rupees 71. In that, add profit, which is 1/6 of sales, means profit is 1/5 of cost and the amount comes to rupees 2,32,880 and per unit profit is rupees 14.20. If we will add profit in total cost, then the sales value comes to rupees 13,97,280 and per unit price is 85.20. Let's understand working note for this solution. Working note number 1, here per unit cost of current production and opening stock are different. Working number 2, when non-information is provided about valuation of stock is given, in such situation FIFO method will be used. Therefore, in this case value of closing stock of 400 unit will be rupees 26,000, administration cost of goods produced rupees 10,40,000 divided by total production 16,000 multiplied by units of closing stock 400. The valuation of closing stock is not confined to finished stock only. The valuation stock of raw material and work in progress are equally important. Now, we will see illustration where information about all these stock is provided. Let's understand illustration 3. Radha Company Limited has provided its cost data to prepare cost sheet stating total cost. Stock of raw material is given on 1st April 2022 as rupees 80,000 and on 31st March 2023 it is given as 90,000. Stock of work in progress as opening given is 30,000 and closing given is 40,000. Stock of finished goods opening value 1,60,000, closing value 1,12,000. Purchase of raw material at the end of the year 14,20,000. Direct wages for the year 6,90,000. Factory overheads 2,30,000. Office overheads 2,32,000. Selling and distribution overhead, in that selling overheads given are 1,60,000 and distribution overhead are 40,000 making total of rupees 2 lakh. Sales given is rupees 35 lakhs. Solution. Number 1, information for quantity is not provided, thus per unit calculation is not needed. Second, sales is provided, so profit is to be ascertained. Third, stock valuation of work in progress should be done on factory cost. Number 4, selling and distribution expenses are given separately. And number 5, no bifurcation of fixed and variable overhead is provided. Let's prepare statement. Direct material opening stock given is 80,000. Add purchase of raw material given is 14,20,000 making total of 15 lakhs. From this less closing stock of raw material 90,000 which will give us cost of goods consumed 14,10,000. In that add direct wages 6,90,000 giving us prime cost of rupees 21 lakh. In prime cost add factory overhead 2,30,000, add opening stock of work in progress 30,000 less closing stock of work in progress 40,000 giving figure of rupees 2,20,000 and we will arrive at factory or works cost as 23,20,000. In works cost add office overhead 2,32,000, administration or office cost of goods produced comes to rupees 25,52,000. In that add opening stock of finished goods 1,60,000 less closing stock of finished goods rupees 1,12,000 which will give us administration or office cost of goods sold as rupees 26 lakh. In that add selling overhead 1,60,000, distribution overhead 40,000. Therefore, cost of sales comes to rupees 28 lakhs. In that add profit which will become our balancing figure as no information is given for profit, but sales figure is given in the example as 35 lakhs. Therefore, difference between sales and total cost is our profit. Agli side. Cost of sales is rupees 28 lakhs. Now, profit figure is not given or profit instruction is not given, but sales amount is given in the example as rupees 35 lakhs. Therefore, difference between sales and cost of sales is rupees 7 lakh which is our balancing figure and that is profit. We will see another illustration where factory overhead is based on machine hour rate. Let's understand illustration 4. you are provided cost data of Dev Company Limited and asked to prepare cost sheet. Purchase of direct material rupees 1,15,000, carriage inward rupees 4,000, direct wages rupees 96,000, machine hours worked rupees 10,000, machine hour rate rupees 4 per hour, opening stock of raw materials 25,000, opening stock of finished goods 4,000 units and its value is rupees 40,000, closing stock of raw materials 20,000, closing stock of finished goods 5,000 units, opening stock of WIP 5,000 units, closing stock of WIP 15,000, office overhead 4% of work cost, selling and distribution expenses rupees 1 per unit and sales is rupees 3 lakhs. Production during the year 26,000 units. Let us prepare solution. For that, first in this illustration sales units are not given, thus sales units are to be ascertained and production account is to be prepared. So, under production account on debit side opening stock given is 4,000 units, production given is 26,000, closing stock given is 5,000 units. Therefore, the balancing figure is sales which is 25,000. Number 2, factory overheads are not given directly, but machine hours worked and its per hour rate is given. Thus, factory overhead will be 10,000 machine hours into rupees 4 per hour, which is equal to rupees 40,000 factory overhead. Let us prepare statement. Opening stock of direct material units is 26,000 and amount is rupees 25,000. In that, add purchase of raw materials rupees 1,15,000, add inward expenses rupees 4,000, making total of rupees 1,44,000. From this, less closing stock of raw materials rupees 20,000, giving us cost of goods consumed as rupees 1,24,000 and units 26,000. In that, add direct wages of rupees 96,000, which will give us prime cost of rupees 2,20,000. In prime cost, add factory overhead which is 10,000 hours into rupees 4 per hour, which will give us rupees 40,000. In factory overhead, add opening stock of work in progress 5,000 and less closing stock of work in progress 15,000, giving us factory or work cost as rupees 2,50,000. In factory cost, add office overhead which is 4% of work cost of rupees 2,50,000 and amount comes to rupees 10,000. Therefore, the office cost of goods produced comes to rupees 2,60,000. In that, add opening stock of finished goods, units given are 4,000 and valuation given is rupees 40,000. From that, less closing stock of finished goods, amount is rupees 50,000 and units given are 5,000 units, which will give us office costs of goods sold, that is 2,50,000. In that, add selling and distribution expenses rupees 25,000, which will give us cost of sales or total cost as rupees 2,75,000. In that, add profit, will arrive at sales. Here, profit will become our balancing figure as no information is given in the example for profit, but sales figure is given as rupees 3 lakhs. So, 3 lakhs minus cost of sales 2,75,000 and the difference 25,000 is our profit. During determination of cost, some special kind of events takes place. It is essential to record these events at appropriate place in cost accounts for precise and correct cost determination. In case of unit cost costing, there are several events which may take place. For their recording requires clear understanding and relevance. Let us see those events and their accounting treatment. First, The name of the event or the case is abnormal loss of raw material and the accounting treatment is deducted from the cost of material consumed. Second, in case of abnormal loss of finished output, it is deducted from the cost of goods produced. Third, scrap value of normal loss of raw material, it is deducted from the cost of materials purchased. Fourth, scrap value of normal loss of finished output, it is deducted from the cost of goods produced. Fifth, scrap value of abnormal loss of raw material, it is not shown in cost sheet but credited to profit and loss account. Next, scrap value of abnormal loss of finished output, it is not shown in cost sheet but credited to profit and loss account. Next case is cost of rectification of normal defective output, it is added to factory cost. Next, cost of rectification of abnormal defective output, it is not shown in cost sheet but debited to profit and loss account. Next item is cost of normal idle time in factory, it is treated as part of factory expenses. Next is cost of abnormal idle time in factory, it is not shown in cost sheet but debited to profit and loss account. Next amount is royalty on units produced, it is treated as direct expenses. Next is royalty on units sold, it is treated as part of selling and distribution expense. Next item is insurance of raw material, it is added to the cost of materials purchased. Next is special mold for casting taken on hire, it is treated as direct expenses. Next, hire of special tools, it is treated as direct expense. Next, drawing office expenses, it is treated as a part of factory expenses. Primary packing materials consumed, it is treated as direct expenses. Secondary packing material consumed, it is treated as part of selling and distribution expenses. Rolling mill expenses, it is treated as part of factory expenses. Power plant expenses, it is treated as part of factory expenses. Gas turbine running cost, it is considered as part of factory expenses. Water treatment plant expenses, it is treated as part of factory expenses. Experimental expenses, it is treated as part of factory expenses. Estimating expenses of tender, it is considered as part of selling expenses. Cash discount allowed, it is not shown in cost sheet but debited to profit and loss account. Cash discount received, it is also not shown in cost sheet but credited to profit and loss account. Cost of free samples of products distributed, it is deducted from cost of goods produced but cost of free samples forms part of selling expenses. Next item is interest, it is not shown in cost sheet but debited to profit and loss account. Next item is donation, it is also not shown in cost sheet but debited to profit and loss account. Next item is counting house salaries, it is treated as part of selling and distribution expenses. Cost of computer purchase for office, it is depreciation on computer forms part of office and administration expenses. In this part 2, we have studied about estimation or base for charging direct wages and direct expenses as well as of recovery methods of different overheads. These are number 1, direct labor or direct wages can be based on materials consumption. It means direct labor cost will be certain percentage of direct materials. It is possible in material intensive product. Number 2, factory overhead can be based on prime cost or based on machine hour rate or based on labor hour rate. Third, administration overhead can be based on factory cost or can be based on per unit for units produced. Fourth, selling and distribution overhead can be based on administration cost or can be based on per unit for units sold. any appropriate base is used by manufacturing units to arrive at precise estimated cost of a product or for a special order to decide whether order should be accepted or not. To understand this aspect, we have to see the preparation of tender. In tender, estimated price is quoted to the customer for a specific order. During preparation of tender, changes in variable cost and fixed cost are considered so that perfect and accurate price can be quoted. Number 1. How to incorporate changes in cost to quote tender. Number 2. How to determine total cost after having incorporation of changes in cost. These aspects we will study in next part, that is part 3 of unit costing. I hope you liked the session. Thank you.